growing geopolitical concerns. And here to discuss how to navigate it all is Ken Stern, president of Lido Advisors, and a new face to Power Lunch. Welcoming him from the West Coast, Lee Munson, president and CIO of Portfolio Wealth Advisors. Gentlemen, welcome. Since Rick just talked about bonds and the fact that you're not compensated for going out longer in the bond area, how do you feel about bonds here? Is now a time to buy in, have some, and if so, of what duration?
Absolutely have to have some. I mean, you're getting paid for liquidity. It's the first time in how many decades that you actually get paid for liquidity. But do you go out much longer? No, I'm not a bull much longer. I actually think that we should stay in the shorter term periods, wait for it to come to us. The market will come in one way or the other. You choose your entry point.
Lee, what kind of portfolio do you run? 60-40, and so you would have some fixed income in there.
I do. So if I take my bond sleeve, that 40% that I have, first of all, I'm about 35%. I'm a little overweight in stocks, but I've got right now 75% of my bonds are in the short term. Just think 6 month to the 2 year. But I started buying in August when we saw the 10-year hit last October's low at a 4.4. So I put in, 5-10% there. A couple weeks ago when we saw the 10-year hit a 4.7, 4.8, I took a little more exposure there. When I see the 10-year hit a solid 5, maybe a 5.01, just to, maybe we get one more rate hike just to rattle some nerves, I want to back up that truck. But again, I'm talking about backing up the truck and maybe having 35% of my bond sleeve in long duration. So, I'm aggressive for a conservative player.
Long duration would be 10 years.
10 but years. I also have a little bit of the 30. I like the TLT trade, but I have to tell you, that's a pro trade. You have to know what you're doing. Individual investors can get burned that way, but I only need to see a 10-year go from maybe 5.
So can banks, by the way.
Well, we saw that last March.
Yeah.
So I think that if you have an appetite for risk and you want to make some real money in bonds over the next 1 to 2 years, think about the 10-year at 5%, because if rates go a little bit higher, your losses aren't going to be as much as the gains you can make if we just get back to a 4.2, 4.5.
Ken, it sounds like you're also a little bit cautious about the economy here, that both of you. So on stocks, you seem a little bit wary. You're maybe looking for defensive sectors, but they haven't been such great performers this year. So, maybe that's, in other words, dividend yielders have been under pressure. Utilities, we've talked about under pressure. Healthcare hasn't been trading that great. Consumer staples, forget about it.
All of that is absolutely true. The consumer, though, is tired. And at some point, there's going to be a catch up. At some point, the real wages, if they're not keeping up with inflation, and if we have continued inflation, which I do think the rates are having their intended consequence, I think we're not going to have a very, very exciting holiday season. I think there's going to be some disappointment, and it's time to keep powder dry. And it's also about the velocity. I agree with what you say, Lee, on the 5%. But if we hit 5% quickly, the market's going to be a lot cheaper, and I'm going to be a much bigger bull.
You're very positive long term.
Oh, my gosh, yes.
Why?
Well, think about it. I mean, inflation was caused because of supply issues. We don't have as nearly the supply issues that we did. And in fact, demand's coming in. We're going to see the sun and the moon and the stars get together. The market just needs to be a little bit cheaper. So either it gets cheaper because earnings start to get accelerated, which they're not quite yet, and the market's a little bit expensive. We need a little cheaper, and then I'm a long-term bull because I love this macro trend. I love trends in finance and healthcare and tech. We're in a macro bull.